Hey guys, I'm Jeremy Delk. Super excited to be here with Brian and the Rental Property Owner podcast. Today we're going to talk about some really cool stuff. About how not to lose $2 million in 4 days, like I did as a college freshman, but also just looking at deals in a different lens. We talk about 2 properties that I did in the last 18 months, which I think are super relevant given election, uncertainty, interest rates, all those. So one is a really successful commercial to resi conversion, and another is actually conventional rental Class B real estate properties to a condo conversion. So yeah, stay tuned and excited to get into it.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 492. Success in business and real estate isn't about playing it safe. It's about disrupting industries, embracing failure, and taking bold action. Jeremy Delk knows this better than anyone. From day trading as a teenager to building Delk Enterprises, a diversified investment firm with holdings in real estate, biotech, technology, and consumer brands, he's made a career out of spotting opportunities, pivoting fast, and challenging the status quo. Jeremy is here today to share why disruption is the key to thriving in real estate and business, and how failure, when embraced the right way, can be the ultimate competitive advantage. Jeremy, welcome to the show.
Thanks for having me. Excited to be here, Brian.
Tell our audience a little bit about yourself and how you got started.
I'm a small town kid from Bardstown, Kentucky. So we're the bourbon capital of the world, a town by 25, 30,000 people. And, growing up, middle class and great childhood. I mean, my father passed away when I was like 7, so that obviously wasn't so great. But for the most part, adolescence and kind of going through was great. Mother, stepfather that loved me, and younger brother. But I always had this kind of yearning I had this feeling like a big fish, small pond, right? It's 25,000 people in our town, and always wanted to kind of go, do more, see more, and be more. And to me, like Sinatra said, that was if you can make it in New York, you can make it anywhere. So that's what I set my sights on, was New York City, with no clue how to get there. And like the only thing I knew about New York is, this is very, let's say sheltered, but just like you live in a bubble, right, in these small towns. And I knew New York was full of mobsters. So like the mafia was like a legitimate option. Besides, my last name kind of screwed me there. Or Wall Street, like that's what I knew, like watching Boiler Room and, Wall Street with Michael Douglas and those things. So that was it. So I ended up writing a book that I won't bore you guys on, called Without a Plan. And it's like the last 20 something years of how I live my life. And it's really has been, it's without a plan, and a memoir of unbound action and failing my way to success. So it was through catastrophic losses and high highs and everything in between that, through a very windy road, and ended me up on Wall Street through Boston. I was the youngest trader, Fidelity history, and then left all that and started Delk Enterprises about 24 years ago.
Given all that, your background, and my condolences for not making it in the mafia. But how did you get into real estate? And I think not having a plan actually helps you pivot when you do experience the disruption. And I think there's been a lot of disruption over the past 20 years, in business and especially in real estate.
With no plan, like it kind of happened accidentally. I was making really good money on Wall Street, but I didn't feel fulfilled. I was driving a BMW. The guy 30 years older than me was driving a Bentley. But that was it. Like, he had nicer stuff. He's been there longer, but we weren't creating anything. And I kind of had this, and I felt very fortunate. I was in my early 20s, no kids, no wife. If it blew up, it was okay. So that kind of gave me the courage to go out on my own. And prior to going fully out, I was making enough money to be a real estate developer, but not in New York City. But it worked in Kentucky. So my very first start in real estate was spec houses. So I was speccing, 1,600 square foot, 3-bed, 2-bath as rentals or for sale, just depending on how it worked out. And then some duplexes, 4plexes, and 8plexes. in Bardstown, and then a town called Radcliffe, which is no one heard of Radcliffe probably, but Fort Knox is in Radcliffe. So a big military presence there. And then that led me into building materials and a whole array of other businesses. As a serial entrepreneur and venture capitalist, you make a lot of bets, but you do kind of feel like a dancing bear sometimes, right? Like it's your job to kind of create this 0 to 1 big piece. So I live my life very lumpy, I think is probably the best way to do it. Is I go through hunker down, and then even though I've done it for 24 years, you kind of feel like, well, can you keep doing it? So what I've done is you make an exit here, sell it. I just get rid of the cash. So like before, if I know I've got money coming in, like we did an exit a few years ago, I knew I had like an extra $3 million that I was going to set aside. I had that. It was in my account for 36 hours. I bought a hotel down in the Caribbean as a boutique property. So I love real estate as an asset class because, as we've all heard, right? God's not making any more land, and population growth, all different things. So I'm pretty diverse in it, from commercial buildings, apartment houses, hotels, luxury properties, all in tape. I just love the real estate asset class because it's got me through some tough times, right? COVID happens, but you still have rental properties kind of going through, or other cash flowing assets. So yeah.
As a serial entrepreneur and a venture capitalist, it's interesting that you're also a real estate investor, because those are very different niches to fill. And I think there's a big difference between venture capital, being a venture capitalist, and a real estate investor. Can you kind of talk about some of those differences and how they relate to your portfolio, and then some of the similarities too?
And I think like everyone hears venture capital and they're like, oh, wow, it's got to be this crazy, elusive, complex thing. And not that it isn't, but it's just taking higher risk, right? So the difference between venture capital and private equity is private equity, it's bigger numbers, but it's usually kind of shared out, and you're taking it from 1 to 10, right? You're just scaling, adding, velocity to it. Venture is much more higher risk, but much higher reward, right? So, 2 out of 10 deals will work, 8 will lose, but the 2 usually pays for the 8. So that's the strategy. So that served me well.
I want to dwell on that point because I think a lot of real estate investors might listen to what you say and not believe you. But in venture capital, you really are trying to get like 1 or 2 out of 10 investments to hit it big, because you're expecting 8 or 9 of those investments of the 10 to not return any money. I mean, isn't that really the case with venture capital?
It is. And, you try to be better with time and try to insulate them and, buy them right and, run them, where it's not just, burning complete cash and get a pathway to revenue. But that's the general consensus, right? I mean, I have shut down many more businesses than I've had that are still there, right? It's just the nature of it. But I've created thousands of jobs and hundreds and hundreds of millions in revenue. So like it does work, but it's just a risk piece. And when you correlate that to real estate, it doesn't work. Don't do that. Don't do 10 real estate deals, because that will not pay for itself. But looking at it in that lens, I think especially now is so critical. I'll give you 2 real life examples, like present day. Like, so I do some, business coaching and equity, consulting for equity, or, just advisory and stuff. And it just pisses me off when you see all these different coaches out there that are like, haven't went through puberty yet. And like, how are you a genius at everything? It just baffles me that you're that smart. But I like to talk about theory. I'm not that smart, but I've just done a lot, and I've learned a lot of lessons, usually through punches in the face and failures. But we have 2 projects that I want to share with you. One, and these are all within the last 18 months. So like, it's not like, oh, glory days. So uncertain economy, presidency, interest rates, all the stuff, post-COVID environment. But you have to look at things through different lenses. And that's what I think I would challenge your guys to do now. So I'm in Lexington, Kentucky. There's a building, it's called The Vine. You guys can look it up, thevinelex.com. We renamed it. This was a 9-story office building right across from the most expensive real estate in Lexington, period. I mean, it was just probably $500 million improvement directly across the street. I mean, unreal comp from that piece. And there was an office building that was owner occupied by a law firm that was on the market for $7 million, which wasn't a bad price, for probably 3 years, 2 years. And I've seen the building goes off and on and moves, whatever. And I had this idea right? For this commercial to resi conversion. And not like I'm a genius, but it was happening in bigger cities. So you can follow trends and see it and say, hey, does this happen in our world, right? You're in Grand Rapids. I'm in, right? Grand Rapids. Is that Michigan? Yeah. So I'm in Lexington, Kentucky. Okay, great. Let's see how we can take these other market trends and see what we can do. So I underwrote that acquisition as an office building play, which is how you would underwrite it. So I ended up through a very long negotiation with lawyers, which was not fun. Like they were a law firm. That's who I was buying from, and lawyers on top. So it was like lawyered to death. But I bought that building for 5.1, which worked out to be like $70 a square foot. Now, with like almost a third of an acre of land downtown Lexington. So like you couldn't have put the steel up for that, right? And we've converted it and put a lot of money into it. But that project will probably be a double, which is rare in real estate transactions. But we paid 5.1 for the building. Less than 12 months, I had closed $7 million in sales and had another 10 million in pre-sales. So you take it and change the perspective. Like, check out the vinelex.com, and it doesn't look like some shabby commercial office building. Now it's a luxury building with record-setting condo prices, restaurant, rooftop, all these different cool things. So it's just looking at something with a different lens where that could be opportunity.
Before you move on, I want to ask you a little bit about that property. So you bought it as an office building, and it sounds like you even pro forma that, ran your projections as an office building or paid for it as an office building. Was this during COVID, pre-COVID, after COVID? I mean,
this was in 23. I bought it in October of 23.
Was it experiencing difficulty just because everyone was working from home still?
It was, but like it cash flowed. So I did my pro forma. So I mean, two models. The model I negotiated with, and then the model of like how I was going to actually make it work. Because it never worked it worked, but it just like it didn't pencil as well as you would look to, which is why it's on the market forever. But I had a lease with the owner for 3 floors. They were paying $45,000 a month. Another bank who's still there now on the 6th floor, they're paying 50, and then a couple other small tenants. So I was getting $60,000 a month in income, and I acquired it for 5, financed 3, interest only. So my payment was like 15 grand. So it was spitting off cash, which was covering my debt service on the construction loan to kind of go through. And then this isn't easy. I mean, this isn't like a layback. I mean, I had lawsuits with tenants. I mean, to make a double in real estate, it's not easy. You got to do some work and kind of deal with some BS with permitting. And I got cranes lifting balconies and stuff. So they're not layups, but there's opportunity there. And that's where the opportunity is if you kind of do the hard work, right? As opposed to like, hey, this is a triple net Walgreens or CVS, which I don't know if you want to buy those right now, but this thing, it's just, family office money and buy it. Yeah, that's great. But you can also do the same type of return in a CD, right? It's not really as exciting. Obviously tax benefit in real estate, but
was your value play then to go in and floor by floor convert it to residential? And were they condos, apartments? Like what exactly?
Condos. So yeah, so it's 9 stories, 7 stories of like occupiable space, 2 of parking. So I bought it for $80 a square foot, and we're currently, $20 million in sales with half of that closed at $800 a square foot. So it pencils.
So why do you call that a double when really that sounds like a grand slam home run?
Well, I'm saying a double on cash on cash, right? It's a double plus equity value, right? So I mean, it's a great win. I will never, unfortunately, get another one. Everyone in town is trying to sell me their building, but I'm like, yeah, I'm a buyer, but it's got to be 80. So like they've seen what I've done, so I won't get it as good of a deal. But we put a ton into it and built a great asset, that we want to hold long term. So we sold out, made our money, took our cash back off the table, and then we'll have a nice restaurant operating that we've got and other things that can, generate income for us. So it's still a hold play, but, we improved our basis and improved the value of the asset and got liquidity through the condo sales, right? Which is nice, as opposed to as an apartment house, I can't get liquidity from that, right? I can buy floor by floor.
How were you able to see that? Like, I'm sure that office, because it's office in 2023, interest rates are going up. I mean, I can see how this perspective of disruption would bring you to that property and say, okay, I can change this use. But what was it that allowed you to even have that vision in the first place?
I mean, just looking for stuff to do. I mean, I think that's part of the curiosity and being an entrepreneur and investor. As I think I don't mention in the green room or in talking to you, but we do a lot of investing, and we've got real estate assets. We've got two beautiful properties in the Caribbean. We've got stuff in Asia. We've got all these great things that have just kind of came around, and then we have some owner occupied stuff. So I've got a 20,000 square foot building I'm talking to you from, which I've always done in real estate. So I'll either start a business, buy a business, but I love buying the real estate. Little company called McDonald's that serves some Big Macs that kind of worked out for them. So own that, depreciate, all the different tax benefits to it, and then pay yourself rent. But from a really cool use, an investment piece, like why can't my dollar stay in Lexington? And that's kind of how it started, and looking for them. And then I'll just go to the next one. I bought this in November of last year. So it's a gamble, right? What's going to happen in the election? I mean, all the things, right? Interest rates, all the stuff. And this was a deal that we looked at and underwrote. It was an investment class B rental real estate, 66 units. It was like $13.5, $14 million. But the cash on cash return worked out to be like 3 or 4%. I mean, it just made no sense. Like you literally could, I mean, other than the only reason it made sense if you had a 1031 or if you just needed some other, tax losses or depreciation, like that's the only reason it kind of made sense. So I didn't need that because I got all the stuff I'm working on. I'm depreciating, I'm expensing a lot of stuff at this Vine project downtown. And we just started looking at it, and they were pretty firm on the number. They had some outside institutions that were looking at it. So, because that's a little bit more than a individual deal. Like I could do it, but like it's not as, not as a layup. So it's not PE, but it's a little bit more of an enterprise user at that price point. And I started maybe I just have a pretty successful condo project downtown. Let me look at that one. Maybe so I can't keep it as an asset, but like maybe I could do something. So there are townhouses, 3-bed, 2.5 bath, 1,600 square feet, attached garage, and we acquired that all in with like closing costs, everything. Where our basis is $191 a unit. Our plan was to put 30 grand into them and sell them for $299. So that was the plan. We bought it in November. No, we bought it in October. We bought it in October of last year. I had my first closing at 314 in November. And funny enough, like, so it's working. So like I needed one comp to reset it. And that was an investor I sold to. And like that created my comp. Then it's election time in November, December, January. We had a ton of weather like you guys had. And then this year we've sold 9 so far. And the funny part about the 9 is we've now raised the prices that we have a baseline of like still 305. We have another one for 324,000. And the thing I just didn't expect, it's in a really good school district. Our market for like that under $300,000 price point is non-existent. So to get something brand new in a good school district is really good. We had 2 units that are under contract right now. They haven't closed for $275,000. Brian, we haven't vacuumed them. Tenants moved out and they bought them because we're scraping ceilings. It's called the Remington Place after my newborn son. We just rebranded it. So it's Remington Place in Lexington. Literally, I'm making more money on those 2 units, not touching them, than I am on the rehab stuff. But so it's been a good deal. So like it's not it's going to make me make profit and go and buy another real estate project, which I'm fine with. But the economics are simple. I bought the building. I bought the units for $13.5 million. I'm going to put $3-ish million into it. So, and then we'll sell it for over 20. So $4 million in value that you create when it's all sold out. I suggest it'll be another 12 months, maybe 18. And yeah, I mean, we financed the deal, I think of it 20% down. So $2 million or so, $2.5 million. So for a cash on cash return, it's a nice deal.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What's interesting about that, and that is disruptive because you don't see that rental to ownership conversion happening. I mean, you used to see it before the Great Recession, leading up to 2008. There were all kinds of apartments converted to condos. But since then, there's just been so much difficulty in making that work that I'm really surprised that you were able to make that work. And a lot of times it has to do with the financing. Like the buyers have trouble getting financing to buy their unit because you got to have at least 50% ownership. So how did you get around that? I mean, that's an interesting aspect there.
We'll get around what piece?
The financing. So your buyers who are paying you $275 to $319 or whatever to purchase their condoized units, essentially, where are they getting the financing from? Because lenders have been it doesn't fit in their box anymore.
I don't know that strategy works everywhere. I think it works more places than you think about because look at it, right? I mean, for your average listener, right? I mean, they're probably, I don't know all of the demographic, but my suspicion is they're buying duplexes and eightplexes and, 12, maybe 12 plexes, right? Like that, if you're just a small time investor, if you are an institutional and I think institutional is $10 to $100 million, if you're in that world, you don't have me and you competing with you, Brian. Like you've got me and you, but then you've got these, aggregators, funds of fund. You just have, the amount of money going after it from BlackRock all the way down is just massive. So, it doesn't make a ton of sense penciling. And again, unless I said you've got a tax problem or a 1031 that you can kind of go into and you just need to put it in so it doesn't have to make sense. But the comp supported it and the comp supported on acquisition. So we obviously pushed the number, but we underwrote it, from a pro forma model of just like it produced itself, right? So just like the last acquisition, we bought it as we were going to keep it a rental price. So it penciled itself for the bank, but the bank saw the upside and how it can go and de-risked it from that piece. So we already had the comps. The way I really hacked it was that first unit falling was to an investor. So they were all cash. So that one didn't have any effect on financing. It was just boom, 315. And then subsequently, we've got first-time home buyers that are getting it and what have you. Another simple trick, right, that makes sense. And I dangled this to the carrot with the bank, like, hey, bank, like I need this, but I'm going to sell it. Would you like, one loan with Delk, which is I'm a good guy, but how would you like 66 others, right? Like that's their bread and butter. So I actually got them to kind of go through. They'd already done the title work. They've done through. So now I can offer these first time home buyers because that's the demographic. Great incentives, all kinds of projects going through. Oh, I'm sorry. And then just the last piece, it's seeing it, but it's selling it. With the $20 million in sales that I've done in downtown, the millions that we've done in this other project, $0 in advertising. And not just in my pocket, like my agent, like I know what she's kind of doing. It's open houses, but it's all social media. It's kind of telling the story and just kind of putting it out there and that awareness. I can't speak to that enough. Just kind of going out there and sharing your vision and sharing your excitement.
Do you have social media accounts and you're shooting video and sharing all of your projects with your audience?
I do. I mean, I don't share like to be honest with you, I've actually never went into the detail on any other podcast. I've just went with you on that. I usually kind of go into that just with like my coaching clients or like people that are looking for me for deal flow. Like I get a lot of deal flow for it. So I mainly put myself out there as like business life coach and then, venture capital. So I try to find companies to buy and invest in. That's usually I put myself into. And then cause that's my main gig, but real estate's just a passion. And I do very well though. I mean, the two projects are very successful. So it's more than a hobby, but it's not my core business. So yeah, it's usually more on the one-on-one stuff. And then we've got people that want to kind of co-invest with us or look at deals. Like you ever heard of Pigeon Forge?
By Gatlinburg there?
Yeah. 6,000 full-time residents, but 15 million annually visit there. So we actually have a deal that we're looking at for some real estate right there on that bypass. I mean, crazy to do an interesting concept with like Crayola and Nerf. So like that's like a $20 million project.
Yeah, great area there. I mean, I love the Pigeon Forge, Gatlinburg area.
Oh, it's really pretty. And like, I mean, just the amount and well, the cool thing about Gatlinburg is that in Tennessee, COVID did not exist. They just didn't, there was no COVID. I mean, it was just wide open. So it was interesting. This last year, because I've got a lot of people that are operating businesses down there because in diligence and we're looking at this deal, they lost about 3% of revenue, tourism revenue last year to the prior year. And majority of that was from Asheville, the floods. So I-40. So you got that. So in order for you to like South, Kentucky, Midwest, going all the way down, that's easy. But anywhere from that, Georgia, South Carolina, or Georgia, you get 75, but any of the Carolina areas, I-40 was just shut down. So you just cut off a massive.
Yeah, I actually have a resort property in Asheville, just outside of Asheville. Called Engadine Inn and Cabins, if anyone wants to check it out. But it's a beautiful property. But you're right, that I-40 got washed out. I think that should be back up and running now. At least I think they've got one lane happening.
My main business is like healthcare and stuff. So we had a group of doctors that were in Asheville and they just came up for an offsite here at our office. And they said it just opened up. It's just really weird. Is it the Pigeon River or there's a bottle of water that kind of joins I-40 and like it was just like it's still not good, I guess. Like it's now passable, but it's not great.
Jeremy, I want to make sure we talk about failure and embracing failure because that is a concept that I brought up in your intro. I mean, how does that apply to your business and experience?
I'm a big failure. I mean, I think that's literally it. So I mean, trying to go fast and I be respectful of everyone's time. That's why I plugged the book because it's, my book gets like reviews of, a good story between The Wolf of Wall Street and Boiler Room. I'm sorry. And the Hangovers, like some really funny stories in there, but I tell everything about the last 24 years of business, but the first manuscript is all business and I ripped it up because it just felt so disingenuous because as you know, right? I mean, business is so personal and I felt disingenuous not sharing the entire side of it. So I got really vulnerable and said, shared like everything. So you may not like me, but you can't call me a liar, right? Like, I mean, I just kind of put everything out there, but I did that to kind of show one, hopefully you don't have to go what I've gone through. I lost my dad at 7. I got $30,000 in inheritance when I was 16. I told you I had this passion for Wall Street. My mom, who has always been so supportive of me, signed over and let me, trade my account as a minor. And I took it out of the Disney mutual fund, Disney stock in a 20th Century Ultra mutual fund, and started piddling around with it in high school. By 19 in college, I'd taken that 30 grand and grown it to just over $2 million with, leverage and stuff. But this was in the 99, right? So this is, if you know what happened, like .com. So I wasn't that smart, but I thought I was a genius. I'm trading stocks on my Palm Pilot, but the bubble burst and I was levered on margin. So if anyone doesn't know what that is, like you basically, if I had $2 million in stock, I could trade 4 million or 3 and change. And margin calls started happening. So just how you can get, scale with leverage, it also works the other way. So I lost that $2 million in 4 days. So that was in the moment, I was the biggest failure ever imaginable. I lost the money that my dad left me. I squandered it. it was just a complete failure. And mind you, I'd bought a condo and I like living the life of probably a 30 or 40-year-old at 20. But I'm a big believer that things don't happen, to you, they happen for you. I mean, I couldn't see it then, but literally that forced me because I had other expenses. I had to go get odd job to odd job while still in school to try to, pay my condo association bills and, my mortgage, all the different things that you didn't typically have as a college kid. And that happenstance through 4 odd jobs, one of them was renting apartments, and I met my future boss at Fidelity. So that thing gave me, so small town kid from Bardstown was in Providence, Rhode Island, going to school. And that's how I ended up on Wall Street. So I don't suggest taking the path of losing $2 million in 4 days to get there. But if you fast forward, the lesson here is humans are innately, self-protective. We're very smart, instinctual individuals. So we don't like to dwell on pain. And that's just a natural thing. Think about going to a funeral, or thinking of death, it's loss, but how quickly you just kind of block it out. And I'm definitely not someone that lives, life in the rear view, but you have to understand, your origin story and why you got there. Not, I think just to be peaceful and comfortable with who you are and loving yourself. But don't forget the resiliency, right? Because if I didn't lose that $2 million, I would have never started Delk Enterprises, because as the 22-year-old living in New York City, making, $300,000-$400,000 a year, great life, it was a very simple conversation. Well, I'm going to go on my own. What's the worst that can happen, right? There was never a scenario that I modeled that I would lose $2 million in 4 days again. So if I got through that, I can go back. So I think that's the piece of the lesson. Like, okay. And then it's, everyone talks about mindset, and you can get a good rep or a bad rep, but it's so true. We always, have this self-protection component in between, and it's always in between our ears, right? It's all us. What if I do this and it fails? What if it doesn't work? And the next thought is like, really, you actually don't think about what the actual result is. You think about, well, what are people going to say? What are people going to think? And I tell people, like, so, I think my kids love me. I think my wife loves me. I know my kids love me. No one else cares about you at all. They don't care. They care about themselves. Everyone has their own problems. So like, you have to remove that from the void, but then ask the other question: what if it does work? Right? Like, what if it does, as opposed to what if it doesn't? What if it does work? And that's something I just challenge my students to look at, because you're asking yourself and telling yourself stories that I think are the wrong questions and the right stories.
Tell our listeners what the book is, where they can find it, and then, anything else you want to plug, how they can find out more about you or get a hold of you.
I'm Jeremy S. Delk on all socials. You can find me on jeremydelk.com. The book is called Without a Plan. It's available Barnes & Noble, Amazon, Target, anywhere you get books. And there's a paperback hard book, and there's an audio version on Audible as well.
Did you read your Audible version?
I did a pretty cool thing. I stole it from David Goggins, so hopefully it doesn't beat me up. But I didn't have the patience. Like, everyone said I should do it, but what I end up reading is intro, narration, but then we kind of had like a cool take on it. I don't know if you listened to Goggins' first book. I don't know if he did it in the second one. I haven't read it, but at the end of each chapter, I did like a little podcast, but it was only with the narrator. So I had the publisher hired like a professional narrator who doesn't sound like me, but he did a great job. And then we have a dialogue after it. So it could be after each chapter. He's like, well, tell me about this thing. So it's like, look, kind of behind the scenes. So it's weird. Everyone asks, like, what should I get? And it's, two different things. Audible gives you, that behind the scenes type of conversation, a little bit more deeper into it. The book, I've got a lot of pictures, because some of these stories I turned down $600 million, ended up having, regulatory challenges in one of my businesses and selling it for $6 million. And, but that's an unbelievable thing. Like, how do you turn down? So like, I took a screenshot of the actual email to the investment bank firm of what we did. So that's the other cool piece that you don't see in the audio version, is some of these pictures of crazy stories in Vegas and Penal, all that different stuff. So they're both good, and we've gotten good reviews from them.
What's your favorite hack or app?
I'm really heavy on AI at the moment. So I've been burning up deep research and ChatGPT. So that's a bit addicting, but you get better and better. It's all about prompting and kind of working through. So we're and this is a great example that you said, that it starts with failure. Like, in one of our big businesses, We spent $800,000 last year building our own LLM, which is like a large language model. And so basically building your own, chat GPT that's centralized for your business. And like, it's gone. Like, it's worthless. Like now with like, it's just like how technology is, the amount of compute and ability. So we just ripped that up. So now it's like, okay, that's not the right approach to build. Like, you need to actually be building like, hey, what can I build on top of this current generation, and only focus on that product use, because Sam Altman's doing some pretty cool stuff, and so is Grok and what have you. So right now it's the AI apps, Grok and ChatGPT.
Jeremy, thanks for coming on the show today and talking about disruption and in real estate, the projects that you've done, which both were, somewhat disruptive, and then embracing failure and using it to, really tell your story and come out ahead. So it's been a real pleasure talking with you today. Thanks so much.
No, Brian, thank you.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIGinvestor.com. And you can also ask questions and join us on Facebook by going to RPOA, Rental Property Owner and Real Estate Investor Podcast. This episode was sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB & Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com.
You've been listening to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association. You can find out more at rpoaonline.org. If you enjoyed this podcast, please go to iTunes to subscribe, rate, and review.